Hey guys, and welcome to a new daily dose of finance, I think we call it now. This will be the first episode that we do. Well, we did one episode yesterday, but this will be the first official. And now we're trying to edit a little bit. We're trying to find out how everything works. I've been trying adjusting my mic a little bit, so I hope it's more pleasant today. Right now we have the chart up for BTC. We will not focus too much on it because it didn't affect the market very nicely on Friday, that's for sure. But you are here to watch today we're gonna do like another Warren Buffett video with Charlie Munger. So I hope it will be great, and maybe we'll learn some more. So let's learn some new stuff together.
I think that a life properly lived is just learn all the time. And I think Berkshire's gained enormously from these investment decisions by learning through a long period. Every time you appoint a new person that's never had big capital allocation experience, it's like rolling the dice. And I think we're way better off having done it so long. But the decisions blend, and the one feature that comes through is the continuous learning. If we had not kept learning, you wouldn't even be here. You'd be alive probably, but not here.
There's nothing like the pain of being in a lousy business to make you appreciate a good one.
Well, there's nothing like getting into a really good one. That's a very pleasant experience, and it's a learning experience. I have a friend who says the first rule of fishing is to fish where the fish are, and the second rule of fishing is to never forget the first rule. And we've gotten good at fishing where the fish are.
Yeah, that's only metaphorically. I went to fish with Charlie one time.
There are too many other boats in the damn water, but the fish are still there.
Yeah, we bought a department store in Baltimore in 1966, and there's really nothing like being in the experience of trying to decide whether you're going to put a new store in a area that hasn't really developed yet enough to support it, but your competitor may move there first, and then you have the decision of whether to jump in, and if you jump in, that kind of spoils it. Now you got two stores where even one store isn't quite justified. How to play those games, those business games, is you learn a lot by trying, and what you really learn is which ones to avoid. I mean, if you just stay out of a bunch of terrible businesses, you're off to a very great start, because we've tried them all.
But you can really learn because the experience is a lot like eating cockleburgers, and it really gets your attention.
Well, we won't expand on that. Andrew Ross Sorkin.
Good morning, Warren. This question comes from a longtime shareholder who, I should tell you, accosted me last night in the lobby of the Hilton Hotel with this question. Warren, for years you stayed away from technology companies, saying they were too hard to predict and didn't have moats. Then you seemed to change your view about technology when you invested in IBM, and again when you recently invested in Apple. But then on Friday you said IBM had not met your expectations and sold a third of our stake. Do you view IBM and Apple differently? And what have you learned about investing in technology companies?
Well, I do view them differently, but obviously, when I bought the IBM, started buying it 6 years ago, I thought it would do better in the 6 years that have elapsed than it has. And Apple, I regard them as being a quite different business. I think Apple is much more of a consumer products business in terms of in terms of sort of analyzing moats around it and consumer behavior and all that sort of thing. It's obviously a product with all kinds of tech built into it. But in terms of laying out what their prospective customers will do in the future as opposed to, say, on IBM's customers. It's a different sort of analysis. That doesn't mean it's correct. And we'll find out over time. But they are two different types of decisions. And I was wrong on the first one, and we'll find out whether I'm right or wrong on the second. But I do not regard them as apples and apples, and I don't quite regard them as apples and oranges. But it's somewhat in between on that. Charlie?
Well, we avoided the tech stocks because we felt we had no advantage there and other people did. And I think that's a good idea, not to play where the other people are better. But if you ask me in retrospect, what was our worst mistake in the tech field? I think we were smart enough to figure out Google. Those ads worked so much better in the early days than anything else. So I would say that we failed you there. And we were smart enough to do it and didn't do it. We do that all the time, too.
Yeah, we were their customer very early on with Geico, for example, and we saw. I don't. These figures are way out of date, but as I remember, we were paying them $10 or $11 a click or something like that. And anytime you're paying somebody $10 or $11 every time somebody just punches a little thing where you've got no cost at all, that's a good business unless somebody's going to take it away from you. And so we were close up seeing the impact of that. And incidentally, if any of you don't have anything to do in your hotel rooms tonight, just keep punching Progressive or something, and you're gonna don't really do that. The thought just happened to cross my mind. But that is, you've never seen a business, almost never seen a business like it, where and I think for LASIK surgery and things like that, I think the figures were, $60 or $70 a click with no incremental, no cost. So, and I knew the guys. I mean, they actually designed their prospectus. They came to see me, and they, a little bit after the original one, when they went public, a little bit after Berkshire even. And so I had plenty of ways to ask questions or anything of the sort, educate myself, but I blew it.
We blew Walmart, too. When it was a total cinch, we were smart enough to figure that out, and we didn't.
Yeah, figuring out execution is what counts. So, anyway, and I could be making two mistakes on IBM. I mean, it's harder to predict, in my view, the winners in various items, or how much price competition will enter in to something like cloud services and all that. I made a statement the other day, which it's really remarkable, and I asked Charlie whether he could think of a situation like it, where one person has built an extraordinary economic machine in two really pretty different industries, almost simultaneously, as has happened.
From a standing start at zero.
From a standing start at zero with competitors with lots of capital and everything else, to do it in retailing and to do it with the cloud, like Jeff Bezos has done. I mean, I mean, people like the Mellons invested in a lot of different industries and all of that, but he has been in effect the CEO simultaneously of two businesses starting from scratch. That if Andy Grove at Intel used to say, think about if you had a silver bullet and you could shoot it and get rid of one of your competitors, who would it be? Well, I think that both in the cloud and in retail, there are a lot of people that would aim that silver bullet at Jeff, and he's done it's a different sort of game. But he's, at the Washington Post, he's played that hand as well as anybody, I think, possibly could. So it's a remarkable business achievement where he's been involved actually in the execution, not just bankrolling it, of two businesses that are probably as feared by their competitors almost as any you can find. Charlie, you got further thoughts?
Well, we're sort of like the Mellons, old-fashioned. people who've done all right. And Jeff Bezos is a different species.
And we missed it entirely, incidentally. We never owned a share of Amazon.
So that was a great video from them, I think. This is like, I don't know the year this was filmed with Berkshire, but of course Google has done very well since then. I just wanted to pull it up at the end of this video. I hope you guys learned something new today, and I think they never missed it, right? They had a huge stake in Apple. But I do think that technology will do well, and as big as Google is, crazy with the number they're saying, like a click would be $11 or what they said. But looking back for Google in 2022, it had like price to sales down to 4, price to free cash flow down to 18, something like that. Are we getting closer right now? Yes, we are. 26 free cash flow and also 5.5 price to sales. So actually kind of in line with March of last year. So I think Google looks really nice right now. It might still dip. I really like buying under this line, the 1,000-day EMA, and I learned this from ValuePig. And this kind of holds me back. If you know the value of the company is great and it has a lot of growth going forward, still, I do believe that we have more safe margin going in under the 1,000-day and investing there. But I'll make a video on Google probably using Seeking Alpha and so on. That was a lot of talking. Now I hope you have a great day. And yeah, enjoy the weather outside, and we'll come back tomorrow.